So you have just inherited money, a house, maybe grandma's jewelry or your parents' business, and now someone says, oh, careful, you will owe inheritance tax. Don't panic. The truth, most Americans will never pay inheritance or gift tax. The rules are confusing enough to make anyone sweat. Hi, I'm Aradhana Agarwal. I am a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And today I'm breaking down inheritance and gift taxes simply, clearly, and without legal jargon. Because when you understand the basics, you can preserve family wealth instead of worrying about it. The biggest myth out there is that everyone pays tax when they inherit money. In reality, heirs usually don't pay federal income tax on inheritances. That's right. Money you inherit is generally not taxable income to you. But that doesn't mean no one pays taxes. Here is the secret. The person who passed away, their estate could owe something called estate tax. And people who give gifts while alive could owe gift tax. So let's separate the two, inheritance versus gift, and see who actually writes the check to the IRS. Here is how it really works in most of the US. There is no federal inheritance tax, meaning you, as the heir, do not pay the IRS. Instead, there is a federal estate tax, and it is paid by the estate of the deceased person before anything is distributed. Now get this. The federal estate tax exemption for 2026 is about $15 million per person. That means if the total estate is under $15 million, no federal estate tax is owed. For a married couple, that's almost $30 million combined. So unless you are inheriting an empire, odds are no federal tax due. A few states, though, like Maryland, Nebraska, and Iowa, may have their own local inheritance or estate taxes. So check your state before you celebrate too soon. This part is a lifesaver for anyone inheriting property, stocks, or real estate. When someone passes away and you inherit an asset, it gets what's called a step up in basis. That means the asset's value resets to what it's worth on the date you inherited it, not what the person originally paid for it. Example, grandpa bought a house in 1980 for $100,000. When he passed, it was worth $500,000. If you inherit it and sell it for $510,000, you only pay tax on $10,000 of gain, not $410,000. That step up protects families from massive capital gain taxes. So always get an official value at the date of inheritance to document your new cost basis. Now let's switch gears. What if you are giving gifts while you are alive? That's where gift tax rules kick in. Here is the breakdown. You can give up to $19,000 per person in 2025, totally tax-free, and you don't even have to report it. If you are married, you and your spouse can each give $19,000 per person. That's $38,000 together. And this is for 2025. Beyond that limit, the giver, not the receiver, may have to file a gift tax return, Form 709, but it still doesn't necessarily mean you will owe tax. How? Because those larger gifts simply use part of your lifetime estate and gift tax exemption, that $15 million that we talked about earlier. So unless you are giving away large fortunes, most people never pay federal gift tax. Now, before you think all inherited money is tax-free, here is where many people get tripped up. Certain inherited assets do create taxable income, even though the inheritance itself is not taxed. Let me explain. Traditional IRAs or 401ks, when you inherit them, you pay income tax as you withdraw the money because the income was never taxed previously. Annuities, often taxable when distributions are made. Old saving bonds, Series E, the interest portion is taxable when redeemed. So while inheritances aren't taxable income, some of the items inside your inheritance are taxed when you cash them out. So how do inheritance and gift taxes work together? They are connected by one big system, the unified estate and gift tax exemption. Think of like a shared bucket of $15 million for 2026. Every time you make taxable gifts during that lifetime, you dip into that bucket. Then when you pass away, whatever is left in that bucket is available to shield your estate from tax. So giving big gifts now can reduce future estate tax, but only if you are near that multi-million dollar threshold. For most families, strategic gifting is more about helping loved ones early while documenting it properly, not tax avoidance. A few extra notes for special cases. State inheritance taxes. Some states like Nebraska, Kentucky, Iowa, they charge inheritance tax based on your relationship to the deceased. Spouses or children often pay nothing. More distant relatives might. Foreign gifts. Receiving a large gift or inheritance from someone outside the US. You may need to report it on Form 3520, even if it's not taxable. The penalty for not filing can be steep. So always tell your CPA about large international transfers. If you are inheriting money, take a deep breath. You are probably not facing a giant tax nightmare. But if you are giving away money or property, plan ahead. Proper documentation, valuation, and smart timing can save your heirs and estate enormous stress and money. Taxes on wealth transfer aren't meant to punish success. They're just rules to keep wealth moving transparently. When you plan early, you control how that story plays out. I'm Aradhna Agarwal, CPA, and whether you're passing down a family business, helping your kids with their first home, or just wondering how much the IRS gets when you're done, we can help you make sure your legacy stays where you want it with your family. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.